Hello there, ladies and gentlemen. Today we're going to be talking about one of the most important things that the Federal Reserve does, which is monetary policy. Monetary policy helps set interest rates in our country. So I'm sure many of you, ladies and gentlemen, want to someday buy a car, buy a house. And if you're going to do that and you're going to borrow to do that, you're going to need to borrow at a certain interest rate. And it is monetary policy that the Fed uses to help set those interest rates. So it is a very important topic for all of us folks that are going to be borrowing money. All right, monetary policy is done at the Federal Reserve Board of Governors, and this is a picture of Mr. Vanderpool in Washington, D.C., standing in front of the Federal Reserve Board of Governors. Now let's talk about what monetary policy is. So monetary policy is the plan to expand or contract the money supply in order to influence the cost and availability of credit, and thus changing the interest rates at which we borrow. Now there's two types of monetary policy. The first one is an easy money policy. It's designed to expand the money supply, increase aggregate demand, and fight unemployment. Okay, an easy money policy is going to lower interest rates, which makes it cheaper for people to borrow and invest. That's going to expand aggregate demand, and it is going to fight unemployment. It's going to lower unemployment. You also have a tight money policy. That does the opposite. It's going to contract the money supply, decrease aggregate demand, and it is usually used to fight inflation. It's going to raise unemployment a little bit. It's going to raise interest rates, making it more expensive to borrow and to invest, and that's going to decrease aggregate demand, but it is a good thing to fight inflation. Now currently in our country we have a little bit more of a problem with unemployment than we do with inflation. So right now the Federal Reserve has an easy money policy. They're keeping interest rates very low in order to fight off that unemployment problem. All right, now let's look at some of the components of monetary policy. What are the tools of monetary policy that the Fed can do? The first one are open market operations. That's the buying and selling of government securities. So the Federal Reserve will buy and sell U.S. Treasury bonds. Remember, U.S. Treasury bonds are just U.S. government debt, and the Federal Reserve will buy and sell those. So if they want a bigger money supply, they buy bonds, which lowers nominal interest rates. If they want a smaller money supply, they sell bonds, and that's going to increase nominal interest rates. So open market operations is going to change what's called the federal funds rate, which is the rate at which banks lend to each other. It's very closely associated with the rate at which we borrow money. Okay, so open market operations affects us quite a bit. Another tool, another component of monetary policy is the discount rate. This is the interest rate that the Fed charges its member banks. So if a member bank decides that it needs to borrow some emergency cash, it can go to the Federal Reserve discount window. That's where you get discount rate, and you can borrow that cash. Okay, they can borrow the cash from the Fed. Now this is embarrassing for that bank to borrow from the discount window, because these banks are in the business of managing money. Okay, if they don't manage their money well, that's embarrassing. It's like a 50-year-old man trying to borrow money from his parents. So most banks are leery of borrowing from the discount rate. Borrowing from the discount window at the discount rate. All right, now let's move on to reserve requirement. The reserve requirement is the money that must be held by banks either in their own vaults or in their accounts at the District Federal Reserve Bank. So most of you guys probably know, if not you will now know, that when we deposit our money in a bank, let's say we start up a checking account, whatever it might be, the bank doesn't just hold on to that money. They will lend out that money, they'll invest it, they'll do stuff with it. But there's a percentage of these reserves, a percentage of this money that the banks have to hold. And that percentage is called the reserve requirement. It's usually somewhere around 10%. So that way, if people want their money, they can come in and the bank will have some money because they have that reserve requirement sitting there. Okay, so the banks can change that to change, to help change their monetary policy. All right, now let's take a look at 3 other tools. These tools are not as important. The 3 tools that we just mentioned, open market operation, discount rate, reserve requirement, those are the major tools that the Fed uses. They can also tinker with margin requirements, the percentage of cash an investor must have to buy stocks and other investments. Okay, high margins are going to discourage investment, slow down the economy. Then you have credit regulation. The Fed can regulate consumer credit in times of national emergency. Okay, they can change payment policies for banks in times of national emergency. And you have moral suasion. These are the unofficial pressures that the Fed will put on the banking system. So years ago during the financial crisis, Bank of America was pressured by the Federal Reserve to buy out Merrill Lynch, and Bank of America did that. There were some issues with that, but nevertheless, that is a good example of moral suasion. The Federal Reserve telling the banking system, this is what we need you to do. Okay. Now, there are definitely some big policy limitations. The first one is economic forecasting. So to do monetary policy, the Federal Reserve has to predict the future, predict the business cycle. That can be very, very difficult to do. So that is definitely a policy limitation. Time lags. There is a lag between when the Federal Reserve decides to do a monetary policy and when you'll actually see the results. So that creates a policy limitation. You have priorities and trade-offs. Okay, lots of times the Federal Reserve has to decide, are they going to fight inflation or are they going to fight unemployment, but they can't fight both. That is a big policy limitation. You have a lack of coordination. The Federal Reserve might want to do something to fight unemployment, but the President of the United States doesn't feel it's a problem. Or more likely, you'll see the Federal Reserve trying to fight inflation, and the President doesn't feel inflation is a problem, and so now you have a back and forth regarding that. So sometimes the President, who has a decent amount of control over the economy, wants something different than the Federal Reserve. You have fiscal and monetary policy. We'll talk about fiscal at another date. But they're going against each other, and that lack of coordination is a policy limitation. And then finally, you have conflicting options. So basically, it's saying that the monetary policy is not an exact science. All right, so let's go ahead and answer our assessment questions here. So for number 1, a tight monetary policy will do what? And 2, which of the following is a policy limitation of the Federal Reserve? I'll give you a few seconds for that. If you have to pause the video, that's perfectly fine. And the summary. Describe 3 components of monetary policy. I would summarize the first 3 that we talked about. So open market operations, discount rate, reserve requirement, those are the main tools of monetary policy. Summarize what those are. All right, so I'll check these notes tomorrow. You have a good day.